Hey, what's up, stock compounders? Brad here. So it is that time of the week again for a Q&A. Actually, we're a little bit late. I usually do the Q&A over the weekend, but I was sick this weekend. I had a cold, the kids had a cold, so I'm a little late here, just trying to catch up. So we're doing the Q&A on Tuesday. Let's dive right in. First question, assuming you have a constant stream of employment income that you can regularly allocate a portion of to investing, why are you not adding to your BABA position? Doesn't your cash pile grow month to month, causing your positions to shrink in size due to the increase in cash? That's a great question. Normally that would be the case. I have two young kids. Within the next year, we're looking to buy property. So, I don't have nearly as much as I usually do flowing into my stock investment portfolio. So because of that, taking a chunk in BABA, there's not a lot of new stuff coming in. BABA has really only dipped about 10% from when I bought in. So, even though everybody sees it's cheap, it's kind of getting cheaper. It's not a lot cheaper than when I originally bought in. So, if it goes down another 10% or 20%, I may have to pull funds from elsewhere to have a bigger stake in BABA, but I'm perfectly comfortable with where it's at right now. Assuming you still own Micron, any interest in adding Micron shares after it hit a low again on Friday? It's been the lowest since January 2021. I also discovered Seth Klarman added Q1 2021 when shares were no lower than 74. I love that. You guys are doing the research for me. This is fantastic. I haven't looked to adding to my Micron position. I took a pretty big stake in 2019. When I first got in, it was around $34 per share. And I'm not necessarily looking to add to Micron. I'm pretty comfortable with the size of that position. That may change. We all know Pabrai sold around 15% of Micron in the last quarter. I still like the company. I think over the next 5 years, it still has a pretty impressive growth potential, but not necessarily looking to add more. I don't see it as a long-term compounder. That's, in step with Pabrai. I've really sort of shifted my focus to those companies where I can buy in and just let that management team, let that company compound my portfolio over time. So Micron isn't as compelling today as it was a couple of years ago. If you found a way to buy Races, would you buy it? If I knew of a way to buy Races, I would certainly take a starter position and I would dig, a lot deeper into trying to reverse engineer what Pabrai sees in the company. I mean, he's already laid out pretty clearly the investment case for Races. So probably wouldn't take much work. I would definitely roll up my sleeves with Races. I just haven't found a way to buy it yet. So how would you identify/vet new gurus to follow? Several points I have been discussing with others include several year CAGR in excess of market, open communication about strategy, gut feeling, ability to identify some recent trades. Yeah, so on those points, I'd want to see a track record that spanned, before the global financial crisis, okay? So that would need to be longer than 13 years. Say a 15-year or longer track record is probably what I would be looking for, because I really want to see how the investor did, not just when the market goes up, but when it goes down as well. Buffett says it's only when the tide goes out that you can see who's been swimming naked. I want to make sure these great investors that I'm following, the returns are risk-adjusted returns. Okay, they're not just piling on the risk to get those extra returns. I want to make sure, they can still fare okay in a downturn. Ideally, do even better in a downturn than when the market is trucking upwards. That tends to be how the greatest investors focus over decades. Is they do better when the market drops, and they keep pace or just fall slightly short of the market when it's going up. So that's important to me. Yeah, I mean, if someone like Pabrai, who puts out monthly, Q&As at business schools around the world, that's really ideal. But sure, if they're writing quarterly letters, even annual letters to shareholders that are open to the public, yeah, it'd be great if they were managing at least $100 million. So we get to see, through the SEC 13F filings, what they're buying and selling. We don't have to rely on them to share what they're buying and when they're exiting those positions. Certainly, if you're cloning a guru, I mean, you really want to know for sure when they're buying and selling, rather than, letting them decide which of those details that they're going to reveal. So, and I'm always adding to this list. I don't even have like a fixed list. I've made videos about this before. There are a bunch of comments about great investors that people like to follow. I've done some stuff on Twitter around this. I'm following a lot of them on Twitter. So I'm kind of slowly over time building up my short list of investors to check out their 13F filings each quarter to find potential new ideas. Why did you leave engineering as a career? So I worked in San Francisco. I have a background in mechanical engineering. I got a job for this company called Architectural Energy Corporation. And the main function of Architectural Energy Corporation was to update the state energy code, Title 24, okay, using the latest ASHRAE standards. Guys, it was so boring, okay? I am not built to work a desk job 9 to 5, 5 days a week. It just doesn't work for me, okay? I would rather have the kind of, job insecurity and, do the hustle thing than be bored, okay? I couldn't do it. So that's why I left engineering. I'm sure there are engineering jobs out there that maybe I could have been content with. But I'm just not that employable in terms of, wanting to fit into that 9 to 5 mold. It's just really not in my DNA. So that's really why I left engineering as a career, and I'm much happier for it. Thanks for that question. If you invested in a position and it grew to be over 40% of your total portfolio, would you take profits and buy other assets or leave it forever? Example, Apple in 2015 at $39 per share. It's a great question. So I'm kind of adopting Monish Pabrai's framework on this, which is if the company is getting better, leave the position alone, okay? And that's really a lesson he picked up from Nick Sleep, and parking your investments with these great long-term compounders. Pabrai says, and others have said this as well, the best investors aren't investors at all. They're entrepreneurs that have never sold, okay? Now, obviously, that's only true if you're an entrepreneur in a business that does really well, right? It's one of these unicorns in a way that has managed to maintain a sustainable competitive advantage over decades. Okay, that's a quite rare situation. So I think we need to keep that in mind. But if you're insightful enough to identify that you have one of those in your portfolio and it gets to be this balloon size in your portfolio, it's taking up the majority of the money in your portfolio, leave it, okay? Because, if it has this kind of DNA, this long-term compounder DNA, you're going to be kicking yourself if you trim it or you sell it. When you find a great business, the best thing for us to do as investors is to know that it's a great business and leave it alone. So that's my take on that. But again, it's a rare situation that we're going to find ourselves owning a company like that. So the best we can do is identify it as such. After your research on Baba, what are the projected growth scenarios you arrived at? How do you compare it to Amazon in the long term? So I'm going to be making more content about Alibaba on YouTube. So I'm going to pass on this one, but I appreciate the nudge to make Baba content specifically around kind of the projected growth. I know Investing with Tom just put out a video about this, so check that out. Sven Carlin, I think he may have touched on this as well. Lots of great investors on YouTube putting out content on Alibaba. Diversification is not a good idea if you understand what you are buying. If one has $1 million and has 2 high conviction ideas, should they deploy the entire $1 million? If not, then why sit in cash? Besides Pabrai, who has a rule system of position sizing for his fund, how do you think other super investors will approach this? Have you found an interesting way to think about position sizing? So on this point, I think this is very important to dig into a little bit. So if you have a couple high conviction ideas, it makes sense to go really heavy in those high conviction ideas, assuming, okay, and this is very important, assuming you are very skilled at analyzing businesses, okay? And that probably necessitates you having been an entrepreneur from an early age, maybe even in that industry, okay? You really have to understand that company and the industry that it operates in, okay? To have just 2 ideas. Pabrai does this. He often just has 1 or 2 or 3 ideas in his personal account. But, you've got to know yourself well enough to be able to say, okay, I definitively understand this well enough to put half of my net worth or half of my investment portfolio into this idea. You've got to really be honest with yourself and know yourself, right? Know what you don't know. So major gut check on that one. It's great in theory. We see Buffett, we see Munger, we see Pabrai doing this kind of thing. But you got to really know your stuff. So make sure that that's the case. In terms of rule systems for position sizing, I don't know. It's not as rigorous for me. I don't have any, great value to add to that conversation at the moment. Do you think it's smart to have at least 1 dividend stock in a concentrated portfolio? I don't. I would much rather have, a handful of companies who are reinvesting earnings into growing the business, right? At a higher rate of return than I could get. All right. Return on invested capital, right? You want a strong business that has very compelling opportunities to reinvest that capital back into the business and earn those high rates of return. And to me, if the company's paying me out dividends, right, then I have to figure out what to do with those dividends. And I've got the double taxation. I don't love dividends. I don't think it's a great way for a business to transfer value to shareholders, at least shareholders who are in my position, where I've got decades left to compound in my portfolio. Perhaps, When I'm in retirement age, I'll be more interested in the dividend payers. But at this point, I'm looking for growth. Okay, I want companies that can reinvest all of those earnings back into growing the business. What is a good allocation for cash as a beginning investor who is dollar cost averaging? So this depends. Are you starting with a lump sum to invest, or are you just taking what's coming in from your job? If you have a lump sum, I would suggest it's probably a good idea to spread it out over maybe 2 or 3 years, maybe investing each month or each quarter a portion of that lump sum over 2 or 3 years. If it's just from income coming in, I don't know that you need any cash as a beginner. If you're not quite confident in your ability to invest, if you're kind of early in the learning cycle, maybe you have a little cash because you don't have that confidence yet to deploy it into ideas as they come along. But if you're, working a job, you're bringing money in each month, I don't think you need to be holding cash, right? Because cash is coming in, and you can use that as opportunities arise. So those are a few thoughts around that. Sankar, thank you for all the amazing work. Absolutely, Sankar. Thank you for sending me that book. Appreciate that. It's a beautiful book. How do you think about the balance between cloned portfolio versus compelling new ideas not owned by gurus yet? For example, FRP holdings, which I talked about in the latest Punch Card Investing episode. My own portfolio is 80 to 85% clone of Monish, and a couple of high conviction bets of other gurus like Warren, Guy Spear, Rakesh. Adding any new ideas also means I am not as concentrated as I should be in my portfolio anymore. Hard balance. Yeah, so I don't really think about it like, okay, this is the allocation I want to have for cloning. This is the allocation I want to have for, maybe smaller companies that gurus, haven't really discovered yet. Yeah, for me, it's not that mathematical. For me, it's, all right, and guru ownership is very high on what makes a potential investment compelling to me. So, there have to be a lot of other boxes checked for me to look at something that isn't owned by an investor that I really respect. FRP holdings, I haven't invested anything into that yet. It's intriguing. I think, I'm going to keep it on my watch list. I'm gonna follow it, but I'm not eager to plow money into that idea at the moment. So, just some thoughts on that. Yeah, I have no issue with anyone saying I just want cloned ideas. I think that's actually pretty wise for most people. People who don't have that early entrepreneurship experience, people who don't want to spend a lot of time going deep into new ideas, bowling with bumpers. There is no shame in being a cloner. That's why it's called shameless cloning, okay? So my thoughts. Have you found stocks that were 1,000 baggers but are now no longer? I looked a little and have not yet found a good example. So when I did my 1,000 baggers research, what did I find? Like 23-ish companies, somewhere around there. I was only looking for returns up until today, okay? So anything that was 1,000 bagger and then fell from grace up to today, didn't really turn up in my research. So I haven't looked at those. I'm sure there are many that have been a 1,000 bagger at some point in the past and then, fell from there. It's capitalism, right? Trees don't grow to the sky, as Howard Marks says. Everything comes to an end. So haven't looked at that, but I'm sure there's plenty to learn from examples like that. How do you value holding companies? Do you just look into market cap of the holdings or calculate the fair value of each holding and then derive a value, or can we straight up use a DCF on the holding company's earnings? So the way I do it, yeah, I usually look at net asset value, right? What are the assets? What are the businesses that the company owns? And then, what is the value today of those companies? Which, come to think of it, that might not be the best way to do it, because that's assuming that the market is pricing those companies in alignment with the intrinsic business value, which, of course, why would we assume that? As a value investor, I don't assume that, because if that were always true, I would never be able to find bargains. But that's kind of the lazy way that I do it. What is the value of the companies in the portfolio based on market cap? It's a lot if you're looking at a holding company and you're trying to really get to the intrinsic value of each holding. I think that's, if it's more than a handful of holdings, or even a handful of holdings, that's going to be a whole lot of work, and you've got to really understand each business. But the way I think about it, what is the net asset value of the holding company, and then what kind of discount is reasonable for that holding company, based on what fees management charges, and other factors. So that's kind of the mile high view of how I value holding companies, but clearly I have some work to do on that. I don't love holding companies. I don't currently own any holding companies. Kind of the closest one I'm thinking about maybe getting into is Pershing Square. Of course, Berkshire as well, when it can be bought at a compelling price. Of course, I'm kicking myself for not buying Berkshire a year ago, in 160, 170 per B share range. But you don't hit them all out of the park. Do you plan to invest in FRP holdings? I'm kind of fighting against the price bias on this. Discount is their scenario mode known, and still I wish we would be in the 48 range. Now I'm curious, Retro Ranger, what is your price bias? Are you just looking at the price history of the stock and saying, oh, well, it was trading at 48, so I should be able to own it at 48? I feel into where that's coming from, because to me that's not very rational. I'd be looking at, what do I think this company is worth today, and what is the price today? Maybe when it was trading at $48, it wasn't worth as much, right? So the whole anchoring thing, it's the fundamentals behind that, the foundation behind that is pretty weak, in my opinion. I don't have any plans, like I said in a previous comment, to invest in FRP holdings. It just, it seemed like a quirky, kind of small investment opportunity that had some interesting storylines with the gravel pits and the company digging a lake, paying FRP to dig a lake for them, where they have these lakefront properties in Fort Myers, Florida. There was a lot of interesting kind of elements of the story in there, but I'm not itching to invest in FRP, but it's on my radar, so I'm probably going to keep learning about it. Is it a smart idea to buy Baba or Tencent through over-the-counter market? Pros, cons, thanks. So Alibaba, it's not available, as far as I understand, through the over-the-counter market. Tencent is. The big thing with the over-the-counter market, it's you just need to do, I think, extra diligence when you're buying OTC stocks, because the regulations are much looser, right? So there's potential for more fraud in the OTC universe versus, stocks listed on larger exchanges. So, but of course, Alibaba, Tencent, I mean, those are very reputable Chinese tech companies. So I wouldn't hesitate to buy those through OTC market. But you've especially with OTC, I mean, with any investment, right? You've got to understand the business. You've got to understand the financials. Is there, misreporting is in there? Are they trying to mislead investors? Is there fraudulent accounting? You've got to know that. And there's going to be more situations like that as a percentage in the over-the-counter market than there is in, the NASDAQ or some of these bigger markets where the reporting requirements are more stringent. So be careful out there. Best advice for compounders early on in their journey, early 20s. First of all, congratulations, early 20s. That is fantastic. That should mean you have like a 50 plus year runway, which is, one of the most incredible assets, quite frankly, for an investor is that long runway. Best advice is invest, okay? You're not going to learn about yourself as an investor. You're not really going to learn about investing until you start doing it, okay? So if you haven't invested anything yet, give yourself, a little time to really dig in and say, all right, a month from now, I'm going to buy my first stock. You don't have to put much into it, but, give yourself a chunk of time to do your research. Say, okay, I'm going to buy this. And that's when the learning really starts, when you have skin in the game, when you have money in the game, when you're a business owner, right? You're a part owner of this public company. So that's my best advice. And then in addition to that, really learn to discern when something is actually a lesson and when it's noise, okay? Learn to tease apart the lessons from the noise as you go along, as you make mistakes, as you do things that turn out well. Really learn to separate those two things. Because in investing, nothing is black and white, okay? It's all probabilities. So, it can be difficult to tease out the sort of true lessons to be gleaned from situations. But that is going to pay huge dividends, especially starting that very early on in your investing journey. Where would you work if you were a young investor with no real skills? Education. So, Pabrai, what did Pabrai do? When Pabrai, he had about 4 years of investing under his belt. I think in 1999, he started investing in 95. In 99, he was like, okay, well, maybe I'll start a fund. But I think even before he said, maybe I'll start a fund, he wrote a letter to Warren Buffett. And he said, Warren, I want to work for you for free. Okay, I just want to learn from you. He wanted an apprenticeship with Warren Buffett. Okay, and to me, that's the best education you're going to get. If you can identify, someone who's doing things the way that you want to do them, reach out to those people and say, I want to work for you for free. You may have to develop some skills. You probably will have to develop some skills. So try to figure out what skills would benefit this person, right? How can there be an energy exchange here, not just me learning from this person? What does this person need? What would this person benefit from? And then develop those skills. Spend a little time developing those skills. And then make the pitch, okay? So everyone has skills. I don't believe that just getting started that you don't have any skills. But some really valuable skills are social media, right? video editing, actually producing content. I mean, these are things that anyone can just pick up and learn how to do. And it's huge. I mean, especially you look at Pabrai. I mean, he's putting out more and more content. Clearly, he's interested in expanding his reach, right? So for us youngsters, I mean, we have a lot of those skills because we grew up with the technology, right? So figure out what skills would really help him, and then make the pitch. So that's my advice. Is VipShop a spawner? What is your opinion? What in your opinion is their moat? So I haven't looked at VipShop. Let me know, Timothy, in the comment to this video. What is VipShop and why should I be interested? J Money, what other platforms, Twitter, Instagram, do you use to help grow your YouTube channel? So honestly, I haven't used any other platforms to help grow my YouTube channel. It's really just been on YouTube. You know, a big part of my early strategy was to figure out, you know, who are the prolific investing channels. You know, Graham Stephan, Andre Zick, Ryan Scribner, you know, Financial Education, all those guys. And, you know, engage in the comments of their videos. If you can, get in there right when they release a video and, you know, leave a comment with something that adds value to the content of the video, to the community. And people will find you, right? People will click on you. They'll make their way back to your channel. It's really been all YouTube. As I'm growing on Twitter, I very rarely post any YouTube content on Twitter. I think there's a lot of people who view Twitter, view Instagram, view TikTok, these other platforms as a way to get more eyeballs on their YouTube videos. I think that's a mistake because Twitter is its own platform, right? It's its own ecosystem. And the things that work on YouTube aren't necessarily going to work on Twitter. And if you're just saying, here's my link to my YouTube video on Twitter, your Twitter account isn't going to grow, okay? It's a different animal. So I really treat them differently. And yeah, so I haven't really tapped into other platforms to grow on YouTube. I think there's plenty to do on YouTube itself to pull some growth levers. Have you looked into Q1 buys from super investors like Coupang, Dominos, Howard Hughes, Grubhub? I did. I made a video about that. Probably around, where are we? I guess that was mid-May. I made a video about that. So check that out. But no, I haven't done a deep dive into Coupang or Domino's Pizza or Howard Hughes or Grubhub. Howard Hughes, I don't know. The business doesn't get me excited. Domino's Pizza, I mean, it's done so well over the last decade. It's like a 17-bagger, Domino's Pizza. But I just, the product, I don't consume the product. You know, it's hard for me to get excited about Domino's, even if the performance has been incredible over the last decade. Coupang is interesting. Kind of talked about as the Amazon of South Korea. But, you know, I haven't gotten there yet. And Pabrai was asked about Coupang in his interview with SumZero. And, you know, people have sent him stuff on it. He hasn't really looked at it yet either. Could be opportunity here. Just haven't gotten around to it yet. Can we get a fancy pie breakdown video of your investments? Probably not. I don't really like to make those kinds of videos because I don't want to be known as the guy who owns this or this or this. Okay, I really want the focus to be on how do I become a better investor? Okay, the process of investing. I think it's very easy for people to fixate on, you know, what different YouTubers own. And, you know, me talking about my positions, right? If I tell you guys everything I own, I'm going to get a ton of questions about those particular companies. And I'm going to be answering to those questions. And I'm going to be digging in everything I believe about those companies. And it's going to leave me not very versatile when things change with those businesses. It's going to be harder for me to make unbiased decisions about what to do when the story changes with those businesses. So, it just doesn't interest me. I don't think it serves my community. It doesn't serve me. It doesn't serve my portfolio. So, probably not going to engage in that one. But thanks for the question, Jake. I'm always waiting for your videos, and I enjoy all of them. Fantastic. Need more subscribers like that. In your last video, you talked about the magic formula on ticker terminal. Yes. Would you use it to make an investment? And have you bought overseas shares already? So I find myself really gravitating towards U.S. equities. Okay, I don't really like to buy public companies outside of the U.S. I think it's just a lot easier for me to wrap my head around businesses that are U.S. based, since I live in the U.S. So I'm probably not going to do a magic formula thing with ticker. I'm going to stick with the magic formula that Joel Greenblatt puts out. It's free. And it's easy enough to use. What I am considering is doing an acquirer's multiple portfolio using ticker as a way to pull that screen for acquirer's multiple companies. I've already started tinkering with that. I'm probably going to put out a video about that this week, about how I might approach an acquirer's multiple kind of mechanical portfolio. So that's what's next on that. I've bought one overseas company. I bought Shinnikin, just a tiny bit of Shinnikin in Japan, through Interactive Brokers, but I haven't added to that since I took that initial stake. And I'm a little uncomfortable about it, just because it's such a different culture. I've never been to Japan, so I'm a little uncomfortable with that one. But it's really a purely shameless clone of Pabrai in terms of Shinnikin. Would you go to the Alibaba 3-day shareholders event one year? Absolutely not. And the reason for that, I don't want to feel good about any of my investments, okay? And going to something like this, I mean, it's going to be fun, probably, right? The CEO is going to get up there and schmooze me. And I don't want all of that in my system, okay? That's all going to throw me off from my ability to make rational, calculated decisions about my investment in Alibaba. So I have no interest in going to a party that's put on by any of the companies that I own. I'm sure it'll be a good time. Do you follow any investing checklist? If so, can you share it? So I don't have a checklist, okay? I probably should. I'm sure, a checklist will emerge at some point. There'll be too much to kind of hold in my head. But, I kind of do it off the cuff right now. Should have, but, I haven't been compelled enough, obviously, to put something like that together. I think Phil Town just did a video where he talks about his checklist. Checklists are pretty easy to come by, so I'm sure you can do a search and find some good ones out there. I know some people on Twitter that I follow also have some pretty detailed investing checklists to look at as well. Can you talk about Micron and why the price dropped, even they beaten the market expectations in earning per share? Yeah, easy answer here. I have no idea why prices move in the short term, okay? And I think anyone who knows why prices move in the short term, they're probably a charlatan, okay? I think it's a big mistake for investors to think that they can know why prices move in the short term. I mean, it's easy to want to do that. You look at the talking heads on TV, and they're so confident about why the market did what it did each day, okay? In my mind, it's largely a load of crap, all right? We don't know why the markets move in the short term. I mean, it's largely investor psychology, right? It's human emotion. It's buying and selling. That's why prices move, okay? When there's more buy pressure, prices go up. When there's more sell pressure, prices go down. So I don't even pay attention to things like that unless it pushes securities into, a compelling buy zone for me, or a compelling sell zone if they're companies I'm not planning on holding for the long term, and I have an idea about where I want to get out. Might present a sell opportunity as well, but I have no idea why Micron price dropped. Yeah, that's the short answer. Your top 5 Twitter accounts to go to for new ideas. Thanks, Karan. So I don't actually want any new ideas, okay? I have enough ideas. I want to go deeper into the businesses that I'm really interested in. So that's where I'm at now. There's plenty of ideas on Twitter. The way I like to use Twitter is, I have this idea that I want to go deeper into. I can search the ticker, right? Say $Baba on Twitter. And I can sort by the people I follow, right? And I can see, of all the people I follow, who's talking about Baba. And I can direct message people who are also invested in Baba, or maybe they're even shorting Baba. I don't know many people shorting Baba right now. Actually, I can't even think of one, but I'm sure there are people. So you guys can easily go to my Twitter account, see who I'm following, and you can even go and click on likes, okay, and see who I'm liking, which posts I'm liking, and who's posting those. There's a lot you can do in Twitter to get a sense for which accounts I like most. But in terms of new ideas, not really looking for new ideas right now. So there you go. Anyway, guys, we'll leave it at that. Thank you all for your questions this week, and I will see you all in the next video. Take care.